and welcome to the Business Standard Morning Show. I'm Kanishka Gupta and let's have a look at the stories for the day. Dussehra marked the end of the 10-day Navratri period last week. After a gap of 2 years, markets were full of keen shoppers, and both offline and online purchases surpassed guesses. The sales of vehicles jumped by an impressive 57%. And it's not the end. Diwali is drawing close and then the new year. So what do the sales data and other indicators from the current festival season suggest about consumption, which has suffered due to persistently high inflation? Find out in our next segment.
High inflation failed to dampen festive spirits during the Navratri as people, especially in cities, went on a shopping spree. The latest CMIE Consumer Pyramids Household Survey shows during September, the index of consumer sentiments rose to a 30-month high. Elaborating on it, Mahesh Vyas, the Managing Director and CEO of the Center for Monitoring Indian Economy, on Monday said, while the consumer sentiments rose by 7.1% in September, the unemployment rate also dropped to a 4-year low of 6.3% during the period. Vyas emphasized that the fall in unemployment rate and the improvement in consumer sentiments was witnessed across both rural and urban regions. While urban consumer sentiments increased 9.3%, rural sentiments rose by 5.6% in September. The respective indices of consumer sentiments were at their highest in 30 months. Although rural India lost some steam in October, its 30-day moving average index of consumer sentiments is at its peak since April 2020. Despite high inflation and high interest rates, the CMIE survey recorded a sharp increase in the propensity of households to buy consumer durables in September across both rural and urban regions. In fact, there are signs of improvement in consumption across segments. The recent Red Seer 2022 e-commerce festive sales report reveals that the online retail market touched $5.7 billion in gross merchandise value, registering about 27% growth from a year earlier during the first week of the festival season from 22nd of September to the 30th. Mobile phones continued to lead the market during this period. The report also found that online shopper base had jumped by 24% over the corresponding period last year. While 65% of the shoppers came from cities other than metros, the spending by each online shopper also increased by 3% during the particular festival week. Auto sales were also buoyed by the festival cheer. The Federation of Automobile Dealers Associations, or FADA, reports that this Navratri, retail vehicle sales were up 57% to almost 540,000 units, from slightly above 340,000 units during the COVID-hit 2021-22. Sales of all categories of automobiles, including two-wheelers, three-wheelers, commercial vehicles and tractors, put up a strong show during the Navratri this year. In a major boost to the automobile sector, not only were overall sales increased by 27% compared to Navratri sales last year, but also 16% above the pre-pandemic 2019 season. The numbers were a clear indication of the fact that after a gap of 3 years, customers are returning to the showrooms in a big way. One of the indicators of a worrisome K-shaped economic recovery has been the recent trend in auto sales, where expensive SUVs have seen brisk sales while two-wheelers found few takers. But this Navratri, even the two-wheeler category, which was showing weakness when compared to pre-COVID months, registered single-digit growth. The current year's two-wheeler sales numbers were 20% higher than 2020 and 4% higher than 2019. In fact, all categories showed positive momentum when compared to the pre-COVID Navratri 2019. FADA estimates this positive trend is likely to continue till Diwali. This indication of a broad-based recovery in consumption will be a welcome trend, since a recent survey conducted by UBS Securities India indicates that affluent consumers were upbeat about spending during the festival season, but those in lower income groups did not share their optimism. A Bank of Baroda report in September shared that the production of daily consumption items, which continued to see elevated price pressures, showed a drop in April-July 2022 and also when compared to pre-pandemic levels. Meanwhile, items like liquor, travel goods, bottled water, aerated drinks, and passenger vehicles, especially in the high-end segment, showed momentum. So, how will the impact of elevated and sticky inflation play out on the purchasing power of certain segments of the population, especially those that have been deeply affected by the COVID-19 pandemic?
So when you're talking in terms of a K-shaped recovery, I think that kind of a trend will continue because there'll be certain sectors which will be doing better, especially in the consumer durable goods segment. In the non-durable, so what we call the FMCG segment, which is what even our study had shown, that we get a different kind of picture where the demand has been a little more lackluster. They're not really picked up because where the price increases have tended to hurt. This kind of K-shaped kind of a recovery is something which we will probably see for the next couple of months.
Citing rising borrowing costs and global risks, the World Bank has cut India's growth forecast for FY23 by a full percentage point to 6.5%. Crude oil prices are on the boil again, even as the Russia-Ukraine war stretches on. At a time when exports can no longer be the engine driving India's economic recovery and the global economy is teetering on the edge of recession, can the country count on its domestic consumption, buoyed by its peak shopping season, to help sustain growth?
Yeah, I think there are definitely indications that the consumption story is back on track. In fact, we had observed that right from the month of April, that is when the financial year began, there was a tendency for consumption to probably grow faster than even investment. And that was something which kept ticking, as reflected mainly by the GST collections, which of course were propped up to a certain extent on account of higher inflation. And right now what we are seeing is a full recovery in terms of overall demand for both goods and services. And that's what's getting reflected in terms of the higher consumption numbers which we're seeing today. But even if you look at other consumption, general retail consumption, even if you look at consumer goods, we've definitely seen an uptick, something which I think is going to continue. No, in fact, I think whatever growth we're going to get this year is going to be driven more by the consumption factor rather than the investment factor or even exports for the matter. So we could be expecting consumption to remain the main anchor for growth for the rest of the year and also for the entire year. And there will be some kind of support coming from the central government in the form of its capital expenditure.
With the export engine sputtering, promoting domestic consumption has become all the more pertinent. The Reserve Bank of India and the government will have to stay laser focused on controlling inflation, which has the potential to impact the purchasing power of consumers.
Railways is also gearing up to meet the festival rush and to make up for some pandemic losses in passenger revenue. But Railways freight operations were not affected by the pandemic upheaval. The revenue of Railways from freight transport jumped by 24% last fiscal, and the government has lined up a host of measures to transform the freight service. Let's find out how.
Over 74% of Indian Railways' revenue comes from its freight operations. It is the backbone of the railways and also supports passenger operations. So the health of the railways depends a lot on how its freight service is performing, and it is doing really well. In the last 2 years, railways freight loading has been impressive. Despite the pandemic, the freight loading in FY21 exceeded that of FY20. Indian Railways ferried 1,418 million tons of freight in FY22, a jump of 15% over the previous fiscal's 1,233 million tons. Railways had recorded 25 straight months of best ever monthly freight loading till September this year. The cumulative freight loading by Indian Railways during the April to September period of current fiscal stood at 736.68 million tons, as against 668.86 million tons achieved in the same period of FY22, representing a growth of 10.14%. And the cumulative earnings from freight stood at 1.43 trillion rupees during fiscal 2022. The annual increment of over 180 million tons was also the highest recorded in a single year. The previous best incremental loading in absolute terms was 66.1 million tons, achieved more than a decade ago in the year 2005-06. Coal accounts for the majority of freight basket, with iron ore being a distant second. In FY22, railways transported over 650 million tons of coal as compared to 542 million tons in FY21, showing a growth of 20%. The uptick in coal transport was mainly driven by increased power demand. After shortages were reported around last year and early this year, railways had ramped up transportation. Coal freight has increased over 32% between September 2021 and March 2022. Anil Kumar Lahoti, General Manager of Central Railway, has said the freight increase seen this year is due to several business development initiatives, including the infrastructure upgrade on Central Railway. One of the highlights of this year's freight business is the increase in automobile loading, as 2,712 rakes have been loaded till September this year, higher by over 70% when compared with the same period of last year. Automobiles' share in Railways' freight basket is very less when compared with the overall volumes. However, Railways has taken several initiatives to boost its share. It had liberalized its Automobile Freight Train Operator or AFTO policy in 2018 with the aim of attracting more interest from automobile companies. Under the revised policy, registration fee for AFTO was reduced by 40% to 3 crore rupees, along with relaxations under the minimum procurement policy. In line with this, there has been a steady rise in automobile traffic in the past few years. Approximate estimates would put automobile freight at close to 4.6 lakh units so far this fiscal year. The government is devising more strategies to fuel auto traffic. To accommodate SUV cars, a new design of auto carrier wagons is under finalization. To facilitate loading and unloading of automobiles, design modification to the existing NMG wagons is also under execution. Automakers are now planning to increase the distribution of vehicles through rail transport by up to 30% by 2027. This share was 16% in FY22. With railways being a cleaner source of transport, higher freight through it contributes to overall reduction of carbon footprint. The speeds of freight trains have also increased over the years, thanks to a plan called Mission Raftar. From FY17 to FY21, the average speed of freight trains has increased from 23.7 km per hour to 41.2 km per hour. Indian Railways is constructing more than 3,000 km of dedicated freight corridor, which would enable freight trains to run at a speed of 100 km per hour. Railways is also looking to diversify its freight basket to reduce dependence on coal. It is planning to ferry more automobiles, consumer goods, and white goods like air conditioners, refrigerators, etc. The diversification plan is steady, as the balance and other goods segment reported a growth of 14% in FY22 over previous fiscal, with an incremental load of 15 million tons. However, the shift might take some time. The loading of miscellaneous goods grew by 14% in September this year. Despite the steady growth this fiscal, the volumes are still short of the ambitious target of loading 1,700 million tons, which is higher than the budget estimates. According to a Business Standard report, there is a need to achieve close to 150 million tons in the coming months to meet the target. The government is also planning to acquire 30,000 wagons in the current year.
One of the reasons is certain commodities have done extremely well during the first 6 months of this year, particularly in the case of coal, which has gone up from 47 million tons in the first 6 months of last year to 54 million tons this year. There has also been a good increment in the case of cement, in the case of fertilizers, in the case of container traffic, and so on. This has been possible because there is demand for this traffic, and the railways has sort of improved on a number of operating parameters. That is, they have now become very conscious of improving speeds, of improving the availability of wagons. So general mobility has gone up. And if you look at the average lead of traffic, that is the length of haul, that has also undergone a substantial increase, which has all cumulatively resulted in better tonnage, better net ton kilometers, and a substantial increase in revenue.
Despite the gains in recent past, Railways' share in overall freight traffic is still low at 26 to 27%, while the majority of the freight is through road transport. The government has designed a national railways plan under which it seeks to increase the share of railways to 40 to 45%. According to some estimates, railways would need to account for over 3,600 million tons in 2031 to meet its model freight share targets. It is also expecting an incremental revenue of at least 30,000 crore rupees per annum from freight services once 300 Gati Shakti cargo terminals are operational in the next 5 years. Even if the economic activity sustains at higher levels and there is an increase in demand for commodities, there are still challenges like last mile connectivity, transit times, and issues with terminals.
Defying headwinds, banks too are expected to report a healthy rise in net profit and net interest income for the September quarter, as successive rate hikes by the Reserve Bank of India failed to curb credit growth. Besides, easing government bond yields in the quarter gone by will support treasury income. Our next report explains how the Q2 report cards of banks look like and the warning signs that investors should be wary of.
After IT companies, financial institutions will be next in line to announce their September quarter results. Starting with HDFC Bank on October 15, Axis, ICICI and IndusInd Bank will report their results next week.
SBI and other public sector banks will follow suit. Going by analysts' estimate, banking and financial services sector could be the best performing sector for a second straight quarter as credit growth remains robust and bond yields cooled off.
I think this quarter is going to be one of the best quarters for banking sector in many years. Loan growth for the sector has picked up to 16% year on year at the end of September versus 13% year on year at the end of June. Margins should expand for the sector because policy rates have gone up by roughly 190 basis points. But bank deposit rates have only gone up by roughly 125 basis points. So we should see some margin expansion this quarter. Third, if you look at bond yields, they are broadly flat QOQ. So banks should not have any mark-to-market losses, which many banks had in the last quarter. And finally, if you look at all the data points, they are suggesting that asset quality is still benign for the sector. So the new NPA creation for the banking sector should be very low, leading to very low provisioning cost during the quarter.
Independent market analyst Ambarish Baliga believes aggregate net profit for the sector may surge around 40% over previous year.
I'm expecting banks to report strong earnings growth on a sequential basis for Q2, looking at the robust credit growth and margin expansion. Y-on-Y operating profit growth should be closer to about 21%. Net profit growth should be about 40%. NII growth is expected to be closer to about 17% Y-on-Y. The larger private sector banks would perform better compared to the smaller ones as well as the PSU banks.
Meanwhile, Bloomberg's consensus estimate pegs net profit growth of the 16 listed banks at 23.4% year-on-year and 20% sequentially. Net interest income, meanwhile, is expected to have risen 10% year-on-year and roughly 10.8% sequentially. That said, the pressure to mobilize deposits amid shrinking liquidity could put pressure on profitability and margins going ahead.
I think one thing where investors should keep an eye on is bank strategy around deposit growth. So if you look at right now, deposit growth for the sector is roughly 9% YY versus loan growth of 16% YY. And banks are funding this gap using the excess liquidity they had created during COVID. But my guess is that they have run out of this liquidity now. So ultimately, they will have to bridge this gap between loan growth and deposit growth. So the strategy will be very important in the sense that it could lead to some margin compression for the banks in the second half or slowdown in the loan growth or both.
As regards today, Q2 results of HCL Technologies and Wipro will be on investors' radar. Retail inflation data for September, Traxon Technologies IPO, oil prices, and other global cues will sway the markets.
From the financial markets, let us move on to the judiciary. Differences have emerged within the Supreme Court Collegium over appointment of judges to the apex court. But what exactly is Collegium and how does it work? Let's find out. It is a group of Chief Justice of India or CJI and the 4 senior most judges of the Supreme Court that decides appointments to the apex court. These appointments could be in the form of elevation when High Court judges are appointed to the Supreme Court, or direct appointments when experienced lawyers may be directly appointed as apex court judges. High courts too have a collegium. They are headed by the Chief Justice of the court. The next 2 senior most judges are part of the High Court Collegium. However, the High Court Collegium only makes recommendations for appointments to the High Court. The final decisions are taken by a collegium of the CJI and 2 senior most judges of the Supreme Court. This collegium of the 3 senior most Supreme Court judges also decides transfers of High Court judges in the country. Under Article 124, the appointment of Supreme Court judges should be made by the President after consultation with such judges of the High Courts and the Supreme Court as the President may deem necessary, all appointments except his or her own. After the 1981 SP Gupta case, also called the first judge's case, it was suggested that the executive must have the biggest say in judicial appointments. 12 years later, in 1993, a 9-judge bench in the second judge's case said that the CJI must be given priority in such appointments. This was reinstated in the third judge's case in 1998. Since then, the judges are appointed by the collegium system. The central government has not been a supporter of the collegium system. According to the government, the current system is not transparent and can be blamed for the high number of vacancies in the judiciary. It has also come under the fire for not being representative enough. Women, Dalits and STs are underrepresented in the higher judiciary in India. In 2014, NDA government had brought National Judicial Appointments Commission NJAC Act to accord a major role to the executive in appointing judges to the higher judiciary. But it was struck down by the Supreme Court in 2015.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Union Minister for Law and Justice Kiran Rijiju has said last month that there was a need to rethink the collegium system so that appointments in the higher judiciary could be accelerated. That is all for today. For more news, views and analysis, please log on to business-standard.com.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.